first things first, we've heard pretty much exclusively when it comes to SVB about how this happened and what it means for depositors out there. And I think we have a pretty firm grasp of most of that at this stage. But would you mind filling us in on the space that SVB really occupied in the startup space?
Yeah. So for a little bit of context, I have north of 100 direct-to-consumer businesses. I teach the subject at Harvard, so I'm pretty close to this industry. And, Silicon Valley Bank was the almost exclusive bank for this entire sector of tech and startup and innovation. And they had a very paternalistic approach. So it wasn't just that they were, custodians of your bank account, like JP Morgan Chase. They might be the lender to your founder. And they might also provide a line of credit in which they would, let people borrow against their illiquid equity, which is highly unusual. So a very paternalistic, entrenched relationship. And while I think we're through this mini crisis, and the government did a phenomenal job, can't believe I'm saying that, but they did. But now the knock-on effects are going to be felt throughout the economy. It's just going to take a little bit of time.
So, Matt, I know a lot of people are thinking of this as really a San Francisco type exclusive deal. We're here out of Needham. I know that they had a branch right here in Wellesley. This is a bank that really did bankroll startups across the country. Is that right?
Yeah, they did. But as we saw, for example, Etsy, they were handling Etsy's, processing of payroll for all those vendors. Everyone listening to me probably has used Etsy at one point, has a favorite vendor. No, their tentacles were pretty deep into the economy and a lot of great companies. And so while it's easy to say, fat cats in Silicon Valley, it's actually not the reality on the ground. And I'll just make it very simple. So if you're a startup, you thought you had a year with a runway because you had a line of credit from this particular bank, and that's now gone overnight. The amount of time that you have to survive and figure out how to get more cash has just been reduced by 30, 40%, whatever the number is.
So, I mean, Matt, I think I know the answer to this, but why, all of these customers are not suddenly just cashing out their deposits and sitting on a whole hoard of cash in a safe somewhere. They're going somewhere else to another bank. Why wouldn't that bank step in and play that same role?
That's a great question. I do think that one of the reasons why a JP Morgan of a Bank of America didn't buy the bank is because they got the bank for free, effectively, because so many of those deposits were looking for a flight to safety, and they went to the too big to fail, right? JP Morgan has $3 trillion. But so here's the simple answer. A couple of years ago when money was free and that money was flowing and interest rates were practically zero, those same banks had an opportunity to take a lot of this debt on, but especially illiquid venture debt, and they rejected it. So now things are significantly worse and more uncertain. I see zero chance that anyone steps in and occupies that role. It just wouldn't be prudent.
Matt, do you have a sense of how SVB came to occupy this space? I mean, I've heard that they either encouraged or by contract required some of their clients to keep all of their funds at that bank. How did they get to this place, I guess is my question.
Yeah, they've been around for about 40 years. There was a point when they ran into similar trouble in the 1990s when they decided they were going to go all in on the real estate sector. They were going to focus on tech, but they were going to put the deposits into real estate because that's quote unquote safe, kind of like treasuries 2 years out right now. And then they got into trouble, and then they pivoted, and so they made a decision. Hey, this is an industry, a vertical that we could own. They went highly concentrated. The question is, what's hindsight at the end of the day? This isn't hindsight. This was completely foreseeable. The FCC identified this very scenario, the chair, on February 28th, that if you have these long-dated maturities, there's going to be a mismatch. And because they didn't have to mark to market, they didn't have to carry it on their books for what these mortgage-backed securities were actually worth, it was just a matter of time. The second problem is when a bank becomes overly concentrated in one sector in which the vast majority of its customers are not FDIC insured, 97% of Silicon Valley Bank customers did not have FDIC insurance. You can predict all it takes is one little bit of teetering to make everybody flee. And because these were high net worth, sophisticated investors at private equity and venture funds, very easy for a few emails to go out and, there's a run on the bank. And if you watch it, It's a Wonderful Life, you can see how George dealt with it, right? So he went and borrowed the money. That's what happened here with the Fed. So, again, hindsight's 2020. But this wasn't a consideration of hindsight. This was foresight. This was predictable.
Matt, practically speaking, for this sector now, I mean, in 2022, there was a pretty big dry up of funds for new startups. It was a pretty big reversal from the cash that was just flowing. The gravy train of 2020 and 2021 started to dry up in 2022. We saw very few companies brought to public markets in 2022, and venture capital firms in general just pulling back to some degree. Are we now going to see an even further pullback, but concentrated in the span of days and weeks rather than months and years?
I do think we are. I talk about it in my book, Burn the Boats, about these different crisis scenarios and how to manage it. But the reality is that America, we are in the middle of a debt crisis. We are laboring under a mountain of debt, $1 trillion of credit card debt. And the canaries were already in the mine in the form of auto loans. I'm sure you've talked about this before, but the number of Americans that are 60 days late on their auto loans right now is higher than it was at the peak of the Great Recession. So that is the canary, on the mine. So we were already going to see a drying up of investments in startups. We were going to see a wave of them are going to go under because they were at inflated valuations, and now they don't have a buyer for that equity. So that was going to happen. What this crisis does is pull forward, that reckoning a lot sooner. Now, one could argue that the inflation will not get under control until unemployment picks up. That's the sad reality that no one is leveling with Americans. That is where the pressure is coming from on wages. Mm-hmm. And so to some extent, a lot of these entities, not being able to continue will lead to some of those layoffs that eventually do need to happen for America to reset.
Matt Higgins, he is the author of Burn the Boats and joined us today to talk about the SVB crisis and a bit of a perspective that I don't think we had taken yet. Matt, really appreciate you coming on.
Thank you for having me, everybody. Stay safe out there.